Welcome to day 3 of the 60-day bookkeeper mini course. Today we're going to start to cover some bookkeeping basics. Now bear in mind this is going to be a very short lesson, what's normally a much longer lesson because these are some very tricky topics for brand new bookkeepers. But today we are going to cover the easiest way to understand debits and credits, how to always know which accounts to use and when, and then we're going to end with a brief overview of the financial statement. So like I said, if you're an experienced bookkeeper, this will be a good refresher. If you're brand new, don't panic if you don't get it right away. It takes a while to sink in. So accounting is like learning a language, and that's exactly what we're going to go over today. We're going to go over the lingo. So debits and credits. The easiest way to remember this, debit means left and credit means right. I don't care if you have to write that down 50 times until it sinks in. Debit means left and credit means right. We'll go into why we care about left and right later, but the key thing for now is to know that every transaction will have at least one debit and at least one credit, and they must balance. So if you think about a teeter-totter, our goal is to make sure that that teeter-totter always balances when we record transactions. So if we put a 5-pound weight on one side and a 5-pound weight on the other side, that's fine, they balance, we have a debit and a credit. If I put a 10-pound weight on one side and two 5-pound weights on the other side, that's still okay. We can have one debit and two credits, or two credits and one debit, or any number of transactions as long as at the end of the day our debits equal our credits. So that's a big overview, and we're going to drill into even more detail and go through why we care about left and right. But for now, just remember, debit means left and credit means right, and those debits have to equal the credits. And that's the basis of everything that we're going to do when we record transactions in the books. All right, the other thing that we're doing as bookkeepers, every time something happens, our job is to analyze the transaction so we can correctly record it. And the way that we analyze a transaction, step one, we have to consider which accounts are affected. So if I have office rent expense and I pay that office rent expense with a check, then I have to consider which accounts are affected there. Oh, okay, well, I paid rent, so that's rent expense, and I spent money, so that's cash, for example. We also have to consider whether they increase or decrease. So in the previous example, if I paid rent expense, well, I'm recognizing rent expense, so that's an increase, right? That's something I'm posting on my books, and I spent cash, so my balance of cash has decreased. Then we're going to determine whether it's a debit or a credit. And again, that just means if we were doing this old school style and we had our ledger out in front of us, we would have a column on the left and a column on the right. So we'd be determining whether we write the amount in the left column, which is a debit, or whether we write the amount in the right-hand column, which is a credit. So again, all of this ties to the way that accounting transactions used to be recorded manually. Now, when you're working in software like QuickBooks Online, the only time you actually need to worry about debits and credits is if you're doing a journal entry. And if you're a brand new bookkeeper, you really probably shouldn't be doing journal entries because they're usually used for error corrections, for prepaids, and for accruals. So if you're not doing any of those items, you shouldn't really need a journal entry, but it's good to have a basic understanding of which accounts increase with a debit, which accounts increase with a credit, and that just gives you a good foundation to build the rest of your bookkeeping knowledge. So we're going to come back to this analyzing transactions. We're going to walk through some examples later, but I'm just giving you a big overview. We've got to finish going through some lingo, and then we'll put it into practice. So the other lingo you need to pick up are accounts. So accounts are the big buckets that we use to record transactions. And the reason that we have these buckets that we group transactions into is because it would be too tedious to record every transaction into its own separate category. So instead, we're going to group our transactions into like categories. And what do I mean by that? So a good example is office expenses. We can buy all kinds of stuff for the office, right? We can buy pens and paper and printer ink and staplers and paper clips, you name it. They're all expenses related to running our office. Now, I don't personally want to sift through a P&L report, which is a profit and loss statement, and have to see, oh, I spent $17 on pens last year and $300 on paper and $57 on printer, right? That's just really not relevant to me when I'm running my business. That's looking at things too small. So rather than have hundreds of teeny tiny buckets that we group transactions into, we find things that are similar and we put them into a bigger bucket. So in this case, our bigger bucket is the office expense account, right? So rather than having pens expense, paper expense, those would be teeny tiny buckets which make the reports hard to read. We put things that we can into bigger buckets as they make sense. And you might be wondering, well, how do I know what size bucket to use? When do I break things smaller? When do I go bigger? That question will depend on your client. So it'd be nice if there was a, hey, for every business of this kind, here is the chart of accounts. And while things are similar, every client is going to be different. So the way I think about it, my goal is to make the chart of accounts intuitive to the client, and I need to capture the buckets in such a way that it makes sense to the client when they look at their statement. So when I hand them their profit and loss report, if they look at office expenses, they know intuitively, these are the items that are in that category. Also, if the client has a budget, that's a great place to start with which categories are relevant to the client. So if I have a client who does a lot of traveling for work, and if on their budget they have different line items for flights, for lodging, for ground transportation, then that tells me that those are items that are meaningful to the client. And so those are the same buckets that I want to create in their QuickBooks Online account. So it's always going to depend on what makes sense for the client. It'll vary by industry, and we'll have some general accounts that are kind of applicable to all of your clients and give us the basis for starting out. And don't worry, QuickBooks Online makes this so easy. They start with a chart of accounts already in there, and then you're just going to modify that as you go to fit your client's needs. So again, remember, accounts are the buckets that we group like transactions into. Now, we have 5 big account types that I want to cover today. And the first of those account types are asset accounts. So assets are the resources a business owns. And some example accounts that are of the asset type are cash, accounts receivable, which is money owed to the business for work they've performed for clients, and those clients or customers haven't paid them yet. Inventory, which is clearly a resource that we own. Prepaid expenses, which is if the company has, let's say they have an annual insurance policy that's huge. For example, I used to work for surgeons, so they'd have, a $24,000 payment for insurance. Well, if I put that whole payment in just 1 month as an insurance expense, it'd make that month look really bad, and it wouldn't be representative of what happened because really they owe $2,000 per month for insurance. So prepaid expenses is an asset account where we sometimes use to handle transactions like that. Again, that's a little bit higher level, but just know it exists. Other asset accounts would be furniture, equipment, buildings. You could have vehicles, anything like that, a resource that the business owns. All right, now asset accounts increase with a debit, which means asset accounts increase on the left. So based on what we just talked about, if I said the client increased cash, you would know that means that cash increases with a debit, cash increases on the left because cash is an asset. So that's the kind of connections you're going to start drawing every time you look at a transaction. And again, remember, our job is to analyze transactions. So we're going to consider which accounts are affected, consider whether they increase or decrease, and then we're going to determine, is that with a debit or a credit? All right, so our next account type are liability accounts. Liabilities are the debts of the business. So if I think about it this way, assets are what we own, liabilities are what we owe. So liability accounts that you'll see on the statements, it could be credit cards, could be loans payable, could be lines of credit. Most of these accounts, you can put the word payable at the end of them, and that's how you know it's a liability account. So liability account, unlike an asset, is going to increase with a credit, which means it increases on the right. So If my credit card, if I charge on my credit card, the balance that I owe to the credit card company increases, which means that my credit card payable account is going to increase with a credit, which means on the right. So let's look at an example. So if I charge $50 for my cell phone bill on the credit card, right? Most of us have bills like that, just set up to auto pay on the credit card. So we need to consider which accounts are affected, consider whether they increase or decrease, and then determine whether that would be a debit or a credit for each piece of that transaction. So the first thing that we're going to look at is 1, consider which accounts are affected. Now you haven't learned about expenses yet, but we're going to go into detail on that next. So I'm just going to go ahead and give you the answer on this one, but we have increased a telephone expense, right? We've recognized that we've spent some money on our phone. And then, since we haven't paid yet, we've put that on the credit card, we're going to increase our credit card payable, right? So we have the telephone expense, that expense has been incurred. It's a cost that we need to run our business. That's how we know it's an expense. And then we haven't paid it yet, so it goes to the credit card payable account. So consider, do each of these accounts increase or decrease? So since we're adding a new telephone expense to our statement, right, we've increased that expense. And since we've added on to our credit card bill, but we haven't paid it yet, that's also an increase. So we've increased the expense and we've increased the credit card payable account. So now we need to determine whether those are debits or credits. Well, expense, you don't know this one yet, but we'll get to it. Expenses increase with a debit, and since the credit card payable is a liability, that's going to increase with a credit. So if we're thinking about our teeter-totter, we have telephone expense, $50 on the left-hand side of that teeter-totter, and then we have our credit card payable, which is our credit card bill, on the right-hand side of the teeter-totter. So both sides are equal. We have a transaction on the left and a transaction on the right. And again, debit means left, credit means right, and they always have to balance. All right, so another account type that we have are owner's equity accounts. And this can be really confusing for students. So owner's equity accounts are the owner's financial interest in the business. So owner's equity can increase when the owner puts money into the business, so it increases with the owner's investment. Owner's draws are when the owner takes out money for themselves out of their business, so that's going to decrease their equity account, which makes sense, right? If you put money in and it increases, then it should decrease when you take the money out. And then if we have positive net income, so the better our business is doing, our business is making positive income, we've got profit, that's going to increase the owner's equity accounts or our financial interest in the business. So equity accounts also increase with a credit. So asset accounts increase with a debit, liability and equity accounts increase with a credit. And don't worry, later after we get through the rest of the account types, I'm going to give you an easy way to remember which is which. All right, so revenue are the earnings from what we're in business to do. So again, this is our fourth major account type, revenue. It's earnings from what we're in business to do. So that could be fee income if you're, an attorney or something. That could be service income. That could be rental income if you're a property manager. That could be sales of product income if you're an e-commerce store and you're selling product. So again, these account names are going to be specific to your client and what they're doing. They might have a unique business where they want their income accounts named something completely different. They might have therapy income, counseling income, marriage workshop income. It really just depends. The whole point is I want my client to be able to look at their statements and go, I know exactly what's in that bucket. And that's how we name the accounts, based on what would make the client go, aha, yes, I know what's in there. All right. So revenue accounts increase with a credit, which means they increase on the right. On the opposite side of revenue, we've got expenses, right? So expenses are the costs that are incurred to generate revenue. So costs that we can incur in our business, we have rent expense, we have utilities expense, we have salaries and wages expense. office expense, you name it. We're going to have all kinds of expenses. These are costs that we've incurred to generate revenue. Now, if revenue increases with a credit, it's safe to assume then that expense accounts will increase with a debit, or on the left-hand side. So I promised that I would show you an easy way to remember this, and so here we go. My acronym for this is dealer. So if you write out the word dealer, on the left-hand side of the word is DEA, and owner's draws, which are, reducing their equity. It's when they take money out of the business. So owner's draws, expenses, and assets, those are the 3 account types that increase with a debit or on the left. So again, those letters are on the left-hand side of the word dealer. On the right-hand side of the word dealer, we have LER, liabilities, equity, and revenues. Those are the accounts that increase with a credit. So if you write out the word dealer, and then you can, draw it down there, draws, expenses, assets, liabilities, equities, revenues. Now, the only thing that might get tricky for you is expenses and equity. You might want to switch those, but the way that you can think about that, logically, expenses and revenues should increase. They shouldn't increase on the same side, right? They're opposites. So that can help you make sure you put them in the right place. The other thing that helps me too is that the word credit has an R in it. So credits are on the right, debits are on the left. Credit has an R for right. So I used to, when I was an accounting student, I would draw this little picture that's here on the right. I would actually draw out my little T with debit on the left, credit on the right, and then write out dealer and put those accounts in there. So if you ever have to stop and think about it and try to figure out, if I have to do a journal entry, how do I handle this? Here's your cheat sheet. And this is the easiest way to remember your debits and credits. All right, so let's put in some practice. So if I paid office rent for $1,400, the first step in analyzing the transaction is to consider which accounts are affected. So if I paid office rent, that means cash had to be spent and I've incurred an expense, right? Expenses are costs incurred to operate our business. So rent expense is the other account that's affected. Now, consider whether they increase or decrease. So if I paid rent, did cash increase or decrease? And I know I can't hear you because it's a recording, but hopefully you're saying decrease. Cash decreased. Now, if I'm recognizing that I have a rent expense this month, am I recording an increase or a decrease in rent expense? I know that you're hopefully on the other side saying increase, right? Rent expense increased. So cash decreased, rent expense increased. Now, the next step is to determine whether that's a debit or a credit for each of those. And the first thing that we have to do is decide what are the account types. So what account type is cash? Now remember, there's 5 major account types. Assets are things that we own. Liabilities, what we owe. Equity, the owner's investment in the business or their financial interest in the business. We have revenue, which is earnings from what we're in business to do. And then we have expenses, which are costs incurred to generate the revenue. So of those 5 asset types, what type is cash? Cash is an asset. And then rent expense, that one's kind of a giveaway because it says expense right in the name. So if we know cash is an asset and we know that it decreased, does that mean that we are debiting it or crediting it? So if cash increases with a debit, because it's an asset account, that's your hint. If cash increases with a debit and we're decreasing cash, then we're going to write that amount in the credit column or on the right. Since rent expense is increasing, expenses increase with a debit, we'd be writing rent expense on the left. So debit means left, credit means right. Assets increase with a debit and decrease with a credit. Expenses increase with a debit and decrease with a credit. So that's a very, very quick overview, by the way. If you got that in these 20 minutes, that's amazing. But it took me a lot longer and it took me a lot of practice to finally have it sink in. So if you're not understanding it fully right now, that's okay. The way that you learn this is practice and repetition. Okay, The other thing that all bookkeepers need to know is the accounting equation. So this is the basis of everything we do. And that accounting equation says that assets must equal liabilities plus owner's equity. Now, if you remember, assets increase with a debit, liabilities increase with a credit, and owner's equity increases with a credit. So that's our teeter-totter right there. It has to equal. Assets must equal liabilities plus owner's equity. Debits must equal credits. Okay, so that's your basic accounting equation. What we own is going to be some combination of what we owe to get those assets and what we've put in, so whatever money we already have, right? That's a really broad, general way to think about it. All right, so I also promised you I'd show you how to know which account to use. So again, whenever a transaction comes through the bank feeds and we need to post that transaction, our job is to stop, analyze the transaction, see which accounts are affected, know what type of accounts those are, and then code it to the right account. Think about what bucket makes the most logical sense. So in order to do that, again, that transaction comes through. So let's say that we're in the bank feeds and we see that on the checking account, they spent $50 at Office Depot, right? So first we have to decide which types of accounts are affected. Now, if they spent cash, cash is an asset, so that's one of our types. The other thing is that most likely this was, let's say that we asked the client and they said, oh yeah, I purchased paper to print on. So that would be an expense. It's costs incurred to run the business, right? So we might code that to office expense. Now, I also want to point out that if you're ever not sure what account to use, we can go to the built-in chart of accounts in QuickBooks and use that for guidance. So here's a screenshot of if you go into QuickBooks Online, for example, you go to the chart of accounts and you click the green new button, like you're going to add a new account. There's the account type. That's the first thing that we selected. So remember, I gave you the big 5 broad ones. We have assets, liabilities, owner's equity, revenue, and expenses. So let's say that we know that the transaction is an expense. It's a cost incurred to run the business. So if we put the account type expenses in, now QuickBooks will give us all these ideas under detail types. So you can scroll down and you can see all of the most common detail types that people are using, the most common expense names that an account can have. And so you can look through those, you can see if there's one that makes sense for what the transaction is for your client. If there's not, you can always change the name. So you could select one of these account detail types, and then where it says name, there's a little star, and you can actually edit that. So if you wanted to call, instead of advertising promotional, maybe they have something more specific like website expenses that they want you to create, that's fine, you can do that. Again, thinking about what buckets make the most sense to our clients. All right, now the reason that these accounts matter and understanding which accounts to use is because you need to know which accounts are on which financial statements and how every transaction you record is going to affect the 2 major financial statements that your clients will most likely care about. And those 2 primary financial statements that we want to deliver to the client every month are the profit and loss or income statement. So I believe QuickBooks calls it a profit and loss, but if you open up an accounting textbook, it's going to be called an income statement, and the balance sheet. So we're going to start with the income statement. The income statement will show you your revenues and expenses for a period of time. And again, revenue is the earnings from what we're in business to do. The expenses are the costs incurred for what we're in business to do. So the difference between our revenue and expenses is our profit. So why does it matter? Because we're in business to make a profit. And so the client cares a lot about the income statement. They want to make sure that their business is healthy, that they're making money, that they're making the right margins. So a pro tip for you, the thing that I love to do is I like to run this statement month over month. And that allows the client to see trends and make sure that their profit margin is trending in the right direction. So let's take a quick look at an income statement. So this is an income statement from the QuickBooks sample file for Craig's Design and Landscaping. And what you'll notice is all of our income accounts are at the top. Now for this client, he has design income, landscaping, pest control. So those are buckets that are relevant to that client. That's why they're broken out that way. You'll also notice that he has advertising, automobile, equipment rental, job expenses. Again, all of the expense categories are going to be items that are relevant to the client. But every time you look at a profit and loss or income statement, you'll have income at the top, then expenses, and then net income here at the very bottom, which is the income minus the expenses. And our goal as a business owner is always to increase this number, right? That's why we call it the bottom line. All right, here's what that would look like if you ran the same report month over month. So in QuickBooks, there's just a setting that you can say, hey, display columns as, and put in months. And I love this one because then the client can see trends. So they can see, oh, for example, my landscaping services have gone up substantially month over month. Or, for expenses, they might be looking at, oh, wow, my automobile expenses went up. Now, if automobile expenses are directly related to landscaping services, for example, maybe that makes sense, right? But the goal is that the client can look at the statements, analyze trends, and make sure that their business is healthy and operating the way that it should be. Now, the other financial statement that you need to know is the balance sheet. So the profit and loss or income statement covered our two major account types for revenues and expenses. Now the balance sheet covers the other three. So the assets, liabilities, and equity accounts are all on the balance sheet at a point in time. So why does it matter? What I love about the balance sheet is that usually all of the items that are listed on a balance sheet can be proven. They can be tied to a source document. So if I run the balance sheet on December 31st, 2019, there's a balance in the bank account, and I can look at the bank account and say, does that match? There's a balance of inventory. I can count inventory on 12/31 and say, does that match? So the balance sheet, not only does it tell the client, the balance between what they own, what they owe, and their financial interest in the company, but it's also something that banks are going to look at to see how risky the client is. So if you have a lot of assets and you don't have a lot of debt, you're less risky than someone whose all of their assets are financed by debt instead of equity. They don't have any skin in the game. So here's what the balance sheet looks like. So the balance sheet is listed in order of liquidity. And by liquidity, I mean it goes in order of things that can be most quickly converted to cash. So cash, bank accounts, those will always be at the top of your balance sheet. So here, this is just the asset section. So this is the top half of my balance sheet. So you can see that I've got checking and savings, I got inventory, we've got a fixed asset of a truck, and notice that the total assets are $23,436.29. The bottom half of the balance sheet covers liabilities and equity accounts. And you'll notice total liabilities and equity, $23,436.29. So the balance sheet is proving that my debits equal my credits, my accounts are in balance. So that's kind of how you can remember. Think about that teeter-totter, that basic accounting equation. Assets equal liabilities plus owner's equity. It's how we know everything has been properly accounted for. All right, so that's our quick lesson today on debits and credits. Hopefully that was helpful for you. If you have questions, go ahead and post those in the Bookkeep Anywhere group. Also tomorrow, watch your email for the QuickBooks Basics lesson. So I'm going to give you some quick tips on QuickBooks, the most common mistakes to watch out for. And so I will see you then.